If you're not prepared for an economic downturn at all times, you could lose everything. When a financial crisis strikes, it's not uncommon for people to lose their jobs that gave them the illusion of stability. Their retirement savings may be halved, and they may even lose their home to the bank. All of these could have long term health consequences and strained relationships. It's easy to forget about bad times when the economy has been performing well for a long time, but there is never a time when the effects of slowdowns should be minimized. Fortunately, when an economic downturn occurs, it creates enormous opportunities for those with a high level of financial stability. This can give them the opportunity to amass wealth far beyond their wildest dreams. Learn how to properly prepare for bad times so that you can take advantage of opportunities as they arise. If you want to improve your financial future, subscribe to the channel and hit the like button if this video is helpful. Now let's get on to the video. A recession, in broad terms, is a significant drop in economic activity that lasts more than a few months. This could be due to a number of factors, including inflation when prices rise and the dollar weakens, or deflation when prices fall and the dollar buys more, and even high interest rates and lending problems. These problems usually lead to higher unemployment, a lack of consumer confidence, people losing their homes, and businesses going bankrupt. Because of these factors, the stock market typically falls as investors panic, lose confidence, and withdraw their funds from the market. To improve your finances at any point in the economic cycle, you must develop the habit of living below your means and spending less than you earn. The difference between your income and expenses is used to invest for the future and pay down debt. Unfortunately, many people fall into the trap of increasing their expenses in direct proportion to their income, resulting in a never ending cycle of barely scraping by. When they get a raise, they immediately put it towards a new car or a larger home. When the tax refund arrives, it's already been spent on a vacation. The phrase, live below your means, may conjure up images of boring or mundane, but there are numerous positive changes that will occur in your life if you begin to do so. Did you know that the average millionaire has 7 income streams? They don't rely on a single paycheck from their job to pay their mortgage, car payments, and other bills, and they are not constantly concerned about being laid off. When your income is diverse, you have less reason to be concerned if one stream of income fails. When you combine living below your means with diversifying your income streams, you'll be able to pay your bills even if something bad happens. Perhaps the most significant advantage of having multiple income streams is the possibility of one of them taking off. For example, a person who works a 9 to 5 job starts a side business detailing cars on weeknights and weekends. With customers lining up for services, the car detailing business becomes a much higher hourly paying job than working in a 9 to 5. They can now quit their full time job and focus solely on the detailing business, earning double or triple what they were previously earning. Paying off debt is not appropriate in every situation, though. Simply put, paying off high interest debt quickly while making minimum payments on low interest debt makes sense. Instead of using every extra dollar you have to pay off low interest loans as soon as possible, that money could be invested to earn more interest than you're paying. Consider whether it would be better to invest extra money that could earn a 10% return instead of paying off debt with a 3% interest rate. This makes mathematical sense, but some people overlook the fact that your monthly needs will be extremely low when you have very little to no debt obligations. Consider how much lower your monthly expenses will be if you don't have a car payment, student loans, credit cards, or even a mortgage compared to someone who's drowning in debt. This puts you in a much better position in the event of a recession and the potential risks that come with an economic downturn, not to mention that you'll sleep much better at night. If you've made it this far, please give this video a like and subscribe to our channel. Now let's get back to the video. How many purchases have you regretted in the past? That brand new car you bought that is now dented, has frequent mechanical issues, and is worth practically nothing? What about that timeshare that was sold to you while you were on vacation? Or the lavish wedding with 300 guests that you invited to marry your now ex-husband or wife? There's nothing wrong with spending money on expensive things if they're important to you and bring you joy. But the problem arises when people make large and small purchases without thinking twice. Spending money on things you might not care about a few days, weeks, or even months after purchasing them will drain your wallet. When you lose your job or your retirement savings, you will be left wondering where all of your hard earned money went. Thinking twice before purchasing an expensive item or carefully considering whether or not to splurge will be appreciated by your future self, and you will receive more joy from each dollar spent by not making a purchase that will be forgotten quickly. When the stock market crashes or there's a recession, it appears that the world as we know it is coming to an end. Will things ever be normal again? It's worth noting that the average recession occurs every 4 years and lasts approximately a year and a half. The average bear market, or when stocks drop at least 20%, occurs approximately every 3.5 years, and this lasts between 9 and 10 months, with the average stock market drop during these periods being around 35%. In short, the stock market drops an average of 35% every 3.5 years, but worry not because it usually recovers in less than a year. It's always unsettling though when your investments lose a significant portion of their value, especially when you're getting older and the idea of replacing those funds appears to be impossible. That's your hard earned money disappearing into thin air. But when you look at history and know what to expect, these events become much easier to bear. Keeping in mind that markets are not always positive, it's definitely suggested to prepare your portfolio for such occurrences and avoid anything you would not want to own if setbacks occur. Maintain a safe level of leverage at all times, which means don't borrow more money than you'd be comfortable with throughout all market cycles. Buying stocks on margin seemed like a good idea when the economy was doing well, but what happens when things start to go wrong? Would you still think that's a good idea, or are you too leveraged? What about your home equity line, which allow you to borrow against a large portion of the value of your home, leaving you with little to no equity? You can easily make the payments now, but what if your income drops? Borrowing money has potential upside, but you must be extremely careful not to over-leverage, and understanding market cycles will help you do so. The worse the market or economy, the better the profit opportunities. Be fearful when others are greedy, and greedy when others are fearful, as Warren Buffett famously stated. When assets reclaim their all-time highs, investors who are well-positioned to buy them at a discount are often handsomely rewarded. Buying the dip is similar to market timing in that it follows the basic investment principle of buy low, sell high. While completely timing the market is difficult, buying stocks during a sharp decline in prices with the intention of holding on to them for a long time is a very simple strategy. This is only prudent if you have a large amount of cash to risk by investing, but for those with extra capital to deploy, a recession may signal an opportunity. It's all too easy to forget how things looked during previous recessions, especially for younger people who have little to no prior memory of them. When the economy is thriving and appears to be unstoppable, the bad times become distant memories. Remembering these times and being prepared for them will put you in a much better position to withstand an income interruption, a significant loss in portfolio value, and it'll even allow you to take advantage of incredible market value. And that just about ends our video. I hope the video was helpful, and please do like the video and subscribe to our channel if you enjoyed our content. See you later!